All right, everybody. So here we are on GBP AUD on the 4-hour time frame, and I would like to go over some of these past trades that I've taken here, and I want to explain them in depth and express how they relate to the 4-hour strategy that I just put out on YouTube. If you guys already watched that 4-hour strategy video, you'll know exactly how simple this is. But here are some real trade examples that were taken on my own and within the Currency Pros community as well. So GBP AUD has been very clean for this strategy so far. In the recent past at least. Now, currently we're actually rejecting this level here too. This fits the strategy. However, I'm not taking this trade because the stop loss would be absolutely massive. The range right now is really big after this bullish movement. So the retracement back to the 71% level, it's just too much of a stop loss for me. I'd have like 140 pip stop loss. That's definitely uncomfortable for me. So I'm staying away from this pair for a while. But if we look at these two recent trades here, this one was for 3.76R and this one was for 2.46R. Very, very clean trades here, guys. And I want to explain them each step by step. So if we go back to this one here, it was very straightforward. We had some bearish structure, right? Lower lows, lower highs, lower lows. And then it started shifting to the upside and we started seeing breaks of structure to the upside. So after this break of structure occurred right here, it left behind significant imbalance, as you can see right here. Let me just highlight it. Between this candle and this candle, we had significant imbalance that needed to be filled. Now, just below that imbalance, we have an order block, right? This candle right here. Or you could look at this entire zone, this entire consolidation as an order block as well. Or you could refine it just down to that one candle. Regardless, once we drag our fib tool from the swing low to the swing high, we can see that our retracement levels, the 71 and the 79, line up very nicely with the extreme of that imbalance, but most importantly, this order block here. Now, both confluences go together to make a highly probable trade, right? The imbalance and the order block. In fact, I could call it 3 confluences because it's in congruence with a clear understanding of bullish market structure, right? We've identified this clear break of structure to the upside, pair that with the fact that we have imbalance and an order block and a deep retracement back into discounted pricing. And this is a very clear buying opportunity. So in this case, I had my limit order set at the 79 because it lined up more with the order block. Luckily that was tagged in just barely, but pushed right up to the high, which is where the take profit is always set because it's framed out based on the Fibonacci tool. So stop loss is at the low, take profit is at the high. It's very simple and it's a fixed risk to reward ratio every time. If you target the 79%, you've got about a 3.75R trading opportunity. If you target the 71%, you get a 2.5R opportunity almost every single time. So it's very predictive, it's very consistent, and it breeds great results. So after that trade hit take profit, you can see that we started consolidating sideways. So there was definitely no trading opportunities within this area here, unless of course you're on a much lower time frame, but that's not what this strategy consists of. We're only trading on the 4-hour time frame. We use this time frame for our overall bias as well as our executions. So of course that requires a great deal of patience because in some cases you can be holding these trades for multiple days or even up to a week, for example. But as you can see, some of these trades pan out very quickly. So if I just measure the distance here from entry to exit, that was less than a day, right? That's 16 hours. Now on this next trade here, let's measure that. I think it was a little bit longer. This was 3 days, see? Significantly longer, right? So the first trade was less than a day. This trade here was 3 days. So it can vary anywhere from 1 to 5 days is kind of like the sweet spot. Anything beyond that, you're risking price just reversing on you because usually these small risk to reward ratio trades, they don't take that long to complete. So anywhere from 1 to 5 days is a good sweet spot for holding. Now with this next trade here, this was literally the exact same process, guys. After this consolidation ran its course and price clearly broke to the upside, let me just identify where the break of structure was. Right here, as soon as price broke through that high and then kind of topped out here and began retracing, that's when you can draw the fib tool, right? As soon as price begins retracing, then we can call this our actual swing high, and then we can draw the fib tool from low to high, and we see where the retracement levels line up with. Now in this case, let me actually use the replay tool just so we can clear this up a little bit and really focus. And I'll hide the fib tool for a second too. So within this bullish range here, what can we see? Well, we obviously have some imbalance way up here, but that's not an ideal place to trade from, right? So we want to look for extremes. Now within this consolidation, we can identify that there's an order block here, right? Very clearly, that last bearish candle prior to the bullish up move that clearly broke structure. So we have an order block there. That's going to line up very nicely with our Fibonacci tool. As you can see, the 71 and the 79 lined up beautifully with that order block. So there isn't really imbalance here other than, I guess you could say, from this candle to this candle, there is definitely a gap there, but it's so minuscule. It's hard to even see unless you have a trained eye, right? So we do have imbalance up here though. Regardless, a lot of our confluences line up here. We have a clear break of structure to the upside. The intent of the market is very distinctive right now. So we want to see a retracement back into discounted prices in hopes that the bullish trend continues, right? So the fact that our retracement levels line up very nicely with this order block, that is a huge confluence. So I was comfortable taking this trade as well. Now you might be wondering, why would I target the 71 instead of the 79? I think back here, it was just luck that the 79 got tagged in. More often than not, the 79 is missed. I'll be completely honest about that. So it's much higher probability to enter based off of the 71%. After only doing like a few trades like this, I realized like, okay, I get missed more often than not. So whenever I do get tagged in, it's more so luck. So I would prefer to just target the 71 because that gives me more consistent results. Like I've said in previous videos, I try and prioritize getting involved in good trades rather than being perfect in my entry. I want to be in the trade because typically my directional bias is always correct. I have a very high strike rate in terms of my directional bias. Like I'm usually not wrong in terms of where the market is going to trade to. Where things get tricky, obviously, is pinpointing a proper entry. That's where the majority of traders really struggled, if I'm being honest. Like everybody wants to go for those sniper entries. And of course they look good on social media, but in reality, they're very hard to consistently achieve. Rather than getting these sniper entries all the time, well, I shouldn't say all the time, I'm missed most of the time. And the odd time that it is that sniper entry, of course, it's wonderful, but it's much more preferable to just be consistently profiting from the market, right? I think we can all agree on that. So in my experience, it's better to actually just target the 71. If you want to have an additional scale in trade, you could obviously set an order at the 79% retracement level as well, just in case it gets tagged in, then it's like an added bonus basically. But the 71% is definitely more consistent. As I trade this strategy, I gain more experience with this understanding. And yeah, so that's basically why I wanted to target the 71 here instead of the 79. Now, if we play this forward, we obviously know what happened, but let's just play it forward anyways. So price tags the entry. And in this case, funny enough, it actually did hit the 79. The risk reward difference is pretty minuscule between the 79 and the 71. So I would rather just get involved in trades, like I said. So this was another textbook trade. I mean, preferably there would be imbalance right next to the order block as well. As we discussed, there was a little minor imbalance between these candles here, but regardless, the confluence still lined up. It was still a very high probability A+ setup. It obviously worked out beautifully, hit the take profit right at the high. And if we just turn off replay mode now, we'll see where price is currently at. So this is literally the same setup repeated, but on a much larger scale. So that's why I'm not interested in actually trading it. So we had the break of structure here, right? But then price just kept going and going and going. Then it finally topped out and started consolidating. And now we have retraced back to the downside. So technically speaking, this is the exact same setup. We could enter from here and we could target the high and put our stop loss at the swing low. But that gives you a 140 pip stop loss, which is just a little much. Now, theoretically speaking, it's still fine. It would still be the same end result. You'd still risk the same amount of money on it. If you use a position size calculator, it's really no difference. But the thing that worries me is that the take profit is worth 341 pips. that is a very, very large take profit. So now we're entering the territory of, okay, is this going to hit the take profit within my typical 1 to 5 days of holding time? Or am I going to have to really test my patience and hold this for like 2 weeks or something like that, 1 to 2 weeks, maybe even 3 weeks, who knows, right? So that's the risk that you incur, and a lot can happen within that time of this trade progressing. So in my opinion, it's better to stay away from these kinds of trades. So these two in the past, with GBP, AUD, these were just textbook trades. I would take these at any opportunity. But trades such as this one here, I'm choosing to opt out of it because it's just too big of a range. Too much could happen within that duration of holding time, and I deem the risk to be too high for my personal liking on my capital. So I really hope you guys enjoyed this breakdown. I'm going to be providing a lot more trade examples of this type of strategy, this swing trading style. I find it to be very beneficial and very positive for my lifestyle, and I'm sure that other people would find the same results if they gave it a good try and stuck with the patience required to make this work. So I really hope you guys enjoyed this video, and I will talk to you all in the next one.